Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing any stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Eni is a multinational oil and gas company. It is one of the 7 super major oil companies in the world, with operations in 66 countries. It operates in many fields including contracting, nuclear power, energy, mining, chemicals and plastics, refining and extraction, and distribution machinery. Last year, it produced 1.7 million barrels of oil equivalent per day. The company is headquartered in Rome, Italy, and was founded in 1953. The ticker trades on the New York Stock Exchange, Deutsche Börse, Mexican Bolsa, London Stock Exchange, Xetra, Vienna, Swiss, Buenos Aires, Brussels, Italian Bourse, and BATS. Let's get started with the model. This is a large cap company, 50 billion market cap. They're trading at $28.50 a share, and they have 1.8 billion shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They had strong free cash flow in 2018 and 2019. It was almost nothing in 2020. Then it was huge in 2021 at 8.3 billion. Net income is the profit or loss on the income statement. It's revenue minus expenses. That was negative in 2020, but massive in 2021. Revenue is the sales for the company, and that was a little higher in 2021 compared to 2018, but much higher than 2020. The US uses WTI as its benchmark, but European countries usually use Brent crude as their benchmark. And the average price for Brent crude in 2020 was $42, and the average price in 2021 was $71 per barrel. So that's why their revenue was so much higher in 2021 than 2020. And they had so much extra free cash flow as well. The amount of oil a company pulls and sells is fairly consistent year to year. But that company's revenue and profits can vary a lot year to year because the price of oil can vary a lot. This is the company's income statement. The top line is the revenue, the sales. All their financials are in euros. I converted these numbers to US dollars on my Excel spreadsheet. So they generated 77 billion euros in 2021. To convert any number from euros to US dollars, you can just add 9%. So you have to multiply these numbers by 1.09. If it's easier, just add 10% to get a ballpark estimate. Below revenue is the cost of revenue. These are all the expenses related to extracting the oil, refining it, marketing, everything. Revenue minus cost of revenue gives you your gross profit, and that's pretty similar to 2018. Their gross profit grew more than 4 times from 2020, but their revenue didn't even double. So you can see how much better their margins are in 2021 compared to 2020. An example of an operating expense is the payroll for support functions. Gross profit minus operating expenses gives you your operating income, and that was the highest ever at 12 billion. A lot higher than 2018 with similar revenue. They spent 4.2 billion of interest on their debt, which was lower than 2020. Then you have other income and expenses. These are all the gains or losses not part of the company's core operations. If you see a big negative, it's likely an asset impairment. Then you have your pre-tax income, then your taxes, and the bottom line of the income statement is your net income. Then net income looks terrible in 2020 because they had low operating income and they passed through a non-cash loss of 5 billion. Even if you exclude the asset impairment, they would still have negative net income, just not as bad. But you can see how much more profitable they are in 2021 compared to 2018 with similar revenue. This is the company's income statement directly from their financial reporting. This shows us 2020, 2021, the fourth quarter of 2020, and the fourth quarter of 2021. Their revenue from operations was 77 billion in 2021, 22 billion euros from exploration and production. This is the upstream process of oil and gas. Then you have global gas and liquefied natural gas portfolio. This is mostly gas sold outside of Italy. Then you have refining and marketing and chemicals. That's their biggest at 40 billion. Refining is turning the raw oil into a usable product like jet fuel or gasoline. Refining is a downstream and marketing is a midstream part of the oil and gas process. Plenitude and power, 11 billion. The way they define plenitude in their report, it combines renewables, customers, and e-mobility. which will enable the company to reduce their gas emissions. Here's a breakdown of Plenitude and Power. This includes retail gas sales, retail power sales to end customers. These numbers are not dollar amounts. This is the volume they sold. 1,137 megawatts from installed capacity from renewables. This 7.85 is how many billion of cubic meters. This negative 19 billion is so they don't double count because some numbers are in multiple buckets. You can see how much these numbers went up, especially global gas and LNG. It went up 200% from 2020. They had 55 billion of expenses related to the revenue, 2.9 billion of payroll, 7 billion of depreciation, depletion, and amortization. So their operating profit was 12 billion. Last year was negative 3 billion. They received 3.7 billion of interest on their investments, and they paid 4.2 billion of interest on their debt. So their net profit in 2021 was 6 billion. Last year was a net loss of 8.6 billion. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. So they did generate more cash flow in 2018 than 2021, but 2021 was still a big year at close to 13 billion euros. And then you have CapEx, investments in property, plant, and equipment. They spent a lot in 2018 and 2019. They spent the lowest in 2020. They spent 5.2 billion euros in 2021. Here's a breakdown of that CapEx. 3.9 billion in exploration and production, 700 million in refining, 440 million in Plenitude and Power, and then 187 million in corporate and other activities. So that was about 5.3 billion euros. If you look at their 2021 presentation, it says they spent 9.3 billion in E&P, exploration and production, compared to 1.5 billion last year. But we just saw all their CapEx was about 5.5 billion. How could they spend 9.3 billion in just exploration and production? That's mainly because accounting rules are made to be confusing, so most people don't understand. I wish they would make it clearer. This 9.3 billion includes everything that was capitalized and also all the expenses that were put directly onto the income statement. When it's put directly onto the income statement, it's not capitalized. Like for instance, research and development is not capitalized. It goes straight to the income statement. It really should be capitalized because those numbers should be smoothed out. When R&D is being performed, it's not usually for something in that time frame. It's to create a product or service that's going to be used over many, many years. That's why a building is capitalized, because you don't use a building in 1 year and throw it away. You use it over a long period of time, 20, 30 years. So that's why you spread the cost over so many years. Operating cash flow minus CapEx gives you your free cash flow. They have a lot of free cash flow, so they paid a big dividend in 2021. They added 1.7 billion of debt in 2021. They added 4.3 billion in 2020. They paid down 2.5 billion in 2019, and they added 1 billion in 2018. And it doesn't look like they're buying back stock. Although we'll look at their financing cash flows in a little bit to confirm, because sometimes Yahoo Finance doesn't pick up all the information. This is their operating cash flow section from their financial reporting. Operating cash flow is net income, which was 6.1 billion. And then you convert that number to cash. So they generated 13 billion of cash flow in 2021. The reason cash flow is higher is because they had 7 billion of depreciation, depletion, and amortization. That's a non-cash item, so we add it back here. We also have to add back 5 billion of income taxes because the taxes they report on their income statement are not the taxes they actually pay. So we add it back here. They actually paid 3.7 billion of taxes, so we minus out 3.7 billion. Last year, even though they reported a big loss, they actually generated nearly 5 billion of cash flow. 7 billion of depreciation, depletion, and amortization, that big impairment of 3.2 billion, and some other items as well. I like to track the revenue of a company, that's the blue line here, and the operating cash flow, that's the orange line. Their revenue looks pretty good. It does move up and down with the price of oil. It was higher in 2015 than it is now, but I have a feeling in 2022 it's going to be higher than 2015. And they generate positive operating cash flow every year. It was getting lower at the end of 2020 and throughout most of 2021, but it looks like it's coming back up. The forecast is for their revenue to remain flat but high for 2022 through 2025. Same thing with their operating cash flow. This is their investing cash flows from their financial reporting. They spent 5 billion on property, plant, and equipment. Last year was 4.5 billion. and they spent $1.9 billion in business acquisitions and $800 million of investments. These may be investments in other companies. If they buy less than 50% of another company, it would go in the investment section. If they buy more than 50%, it would go into the acquisition section. They had a cash outflow of $4.7 billion in receivables. That means they extended credit to other companies. When they get paid for these receivables, then it'll be a cash inflow. Last year, they had a cash inflow of $1.2 billion. So in their investing section, they had a cash outflow of $12 billion. Last year was a cash outflow of $4.5 billion. This is the financing section from their statement of cash flows. They added $3.5 billion of debt. They paid down $2.9 billion of debt. They paid $900 million of leases. They paid $900 million on short-term debt. They paid out $2.4 billion of dividends. Last year was $2 billion. They issued $2 billion of perps. Perpetual bonds have no maturity date. So if you buy a perpetual bond, you'll receive interest payments forever, unless the issuer of that bond buys it back and pays you the principal balance. In their financing section, they had a cash outflow of $2 billion. Last year was a cash inflow of $3 billion. Let's look at the capital structure. $49 billion of equity, $36 billion of debt. They're 57% equity, 43% debt. If they used all the cash on their balance sheet to pay down some of their debt, they would only have $16 billion of debt left over. This blue line is their equity balance since 2015, and it looks like it's been coming down over time, which is not what you want to see. You want to see their equity balance go up. Their debt has been pretty steady. Same thing with their cash balance. It's been pretty steady over the years. I gave them the highest whack on Finbox, 11.3%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated the terminal value, which is all cash flows past year 4. That's $63 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $57 billion. We divide that by 1.8 billion shares. And we get a calculated stock price of $32. They're trading at $29, so they're trading at a 12% discount. It's a buy according to the model. Their revenue is projected to grow 1.4%, so I grew their revenue 1.4% for the next 4 years. That's how I got their future revenue estimates. On average, they convert 6% of their revenue into free cash flow, so I multiplied their future revenue estimates by 6%. That's how I got their future free cash flows. The website Simply Wall Street values the company at $25. They're saying it's 16% overvalued. This is where the stock has been trading the past 5 years. So you can see it was pretty steady for several years. Then it dropped a lot when oil decreased a ton, but it's been coming back up ever since. So you could have made a great return if you got it down here. This is the price of Brent crude for the past 5 years. The patterns do look similar until 2021. Then crude has jumped up to a high point, the highest point in the past 5 years. But their stock price is not higher than it was just in 2020, and it was a lot higher in 2018 and 19. If you invested in this stock in the S&P 500 5 years ago, for the first 3 years they were almost tracking each other, but then the S&P took off, and this stock has really never recovered. So it looks like there's potential for a lot of upside, especially if oil stays at these levels. Maybe this stock price lags oil by a month. If that is the case, then the stock's going to go parabolic in the next month. They pay a semi-annual dividend, and they raised their dividend a lot. In May 2021, it was 58 cents, more than double from September 2020. And then in September 2021, it was over $1. You can't compare over $1 here to over $1 here, because the stock price was a lot higher in 2015 than it is now. Even with a lower dividend, they're paying a higher yield. To calculate the forward dividend yield, I multiplied this 102 by 2, that's $2.04. I took that number and divided by the stock price, and that comes out to over 7%, which the company is able to easily afford. It's only 43% of their free cash flow. You can see their yield in the beginning of 2022 is a little higher than 2019, 18, 17, 16, and 15. The reason their yield is so high in 2020 is because the stock price crashed. The lower the stock price, the higher the yield. The forecast is for their yield to grow a little bit, then stay fairly steady. They pay their next dividend on June 8th. If you buy the stock on May 23rd or after, you will not get the June 8th dividend. If you buy the stock any day before May 23rd, you will get this dividend. They've done one stock split in 2006. That was a 5-for-2 split, or 2.5 to 1. 2021. Their beta is 1.18, so the stock is a little more volatile than the market. It's gone up 15% in the past 52 weeks, while the S&P is up 6%. The 52-week low is 22, the high is 33. And the stock is trading between its 50-day and 200-day moving average. Less than 1 million shares are traded each day. Of the 1.8 billion shares outstanding, 1.2 billion are on float. A little over 1% of the shares are held by institutions, and 0.11% of the shares are shorted. Their employee count is pretty steady the past several years. They employ over 31,000 people. If you invested $10,000 into this company 10 years ago and reinvested the dividends, you'd be at a little over $10,000 today. That's only 6% return. Half the company is owned by the general public, 31% by the Italian government, 19% by institutions. The Italian government owns 26% of the company. Then the Italian state treasury owns 4.5%. BlackRock 3%, then Vanguard, then Norges Bank. Let's look at their financial ratios. And these numbers look amazing. Their PE is 7.5, that's stock price over earnings per share. Price to sales of 0.6, that's stock price over sales per share. And price to book of 1.0, that's stock price over book value per share. Let's look at their non-current assets. 56 billion of PP&E, 4.8 billion of right-of-use assets. This is when any leases an asset that's owned by another company. If the asset is in PP&E, that means any owns the asset. 4.8 billion of intangibles, 1 billion of inventory. Compulsory stock is the requirement of fuel reserves that the supplier must hold. This is a European thing. They don't have this in the United States. They own 6.4 billion in other companies, probably oil and gas companies. 2.6 billion of deferred tax assets. This will decrease their taxes in the future, and a bunch of other smaller items. Let's look at their non-current liabilities. 24 billion of long-term debt, 4.4 billion of long-term leases. These are the leases that are tied to the right-of-use assets. 14 billion of provisions. Provisions are funds a company sets aside for future losses. 800 million of employee provisions, 4.8 billion of deferred tax liabilities. This will increase their taxes in the future, and 2.2 billion of other. They have a good return on invested capital of 16%. They can cover their interest payments with their operating income almost 3 times. They have a good ROE of 14% and a good current ratio and quick ratio, both above 1. Let's look at their current assets. 8 billion of cash, 10 billion of other financial assets, 19 billion of receivables. This is how much money is owed to them. 6 billion of inventory and 14 billion of other. Let's look at their current liabilities. 2.2 billion of debt, 1.8 billion of long-term debt, and 1 billion of lease liabilities. They have 22 billion of payables. This is how much money they owe others, and 16 billion of other. They generated over 8 billion of free cash flow in 2021. They have nearly 16 billion of working capital, and they pay out 3.6 billion of dividend payments. So they have over $20 billion of funding. So the company seems to be really well capitalized. The best way to look at ratios is to compare them to companies in the same industry. There are 20 companies in the same industry as Eni. Eni ranks 10th in market cap. The average is 84 billion. They're at 50 billion. And they have really good ratios. Their price to book, price to earnings, price to free cash flow, and price to sales are a lot better than average. Usually non-US companies have good ratios, since their stock price isn't bid up as much as a US company. And they offer one of the best dividend yields, 7.2%. The average is only 2.1%. So to summarize, I have them trading at a 12% discount. And if anybody has been holding oil stocks, you've been doing really well the past few months. There could be more upside, but you really never know if oil will continue rising or if it will start coming down. If you're looking to double or triple your money, this is probably not the right place. But if you're looking for a long-term hold, then this kind of stock is a pretty safe play. I rank their free cash flows, revenue, and ratios 10 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.